Welcome to part 4 of the super simple spread trades for income. We're going to be talking about the V Condor. Before we get going, we would like to remind you that this presentation is for educational purposes only. We are not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that the risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. And throughout this presentation, we will be doing hypothetical computer simulated trades, which are believed to be as accurately represented as possible. However, live results may vary. The V Condor is a high probability market neutral trade that's designed to take advantage of low to mid volatility markets. It does best when the markets are actually uptrending a little bit. It is essentially a typical high probability condor as far as an entry structure goes, and it has a straddle embedded slightly below the money. Before we get too much into the V Condor strategy, I'd just like to talk about some common mistakes that I see with students who've had really challenging times with condors in general. So some common things that happen or adjustment strategies that we see are adjustment strategies that tend to add risk to the condor. The ones I'm specifically talking about are rolling back and doubling your size. While this often works when you're trading condors, in other words, you get into this condor or iron condor and the market moves too much in one direction, so people will roll back the bad spread. And of course, when you do that, typically what happens is it's going to be very difficult to make money, or maybe you're not going to make as much money. And so to compensate for that, what they do is they double the size or double the risk in the size they roll back, and with a theory that the market's going to turn around and they're going to make the same amount of credit they initially got when they sold the condor itself. Well, two things are going on there. First of all, in order to do that, you literally have to have almost double the capital in the account, or put aside double the capital for the trade. So that instantly cuts your returns in half because you have to have that capital aside in order to deal with that. The other thing, and the more dangerous thing, is that you're doubling your risk and you're increasing your negative delta or positive delta, depending on which direction you're going. And if you get in a situation where you do something like that and you're near your maximum loss level to start with, if you put yourself in that situation and the market happens to gap severely against you the next day or soon afterwards, what ends up happening is you end up taking much, much more than your maximum loss. I've seen people taking devastating losses from this type of a thing where they lose, a year's worth of income or more. So not a very good strategy long term, although, oftentimes it does work out. Another thing that I see people do is rolling down the call spreads. Or in other words, the market comes down a significant amount relatively fast. So they roll back the put spreads. Oftentimes they'll double size it to get the credit, and if that doesn't get them the credit they need, they'll also roll down the call spreads. And the challenge we have with doing that, rolling down the call spreads, is that typically when the market drops quickly, you're going to get an expansion in volatility or an expansion in the price movement back and forth in the index or stock or whatever you happen to be trading your condor in. And when the market does finally bounce, usually that bounce is extremely aggressive. And what ends up happening is traders they'll roll that down, roll it down, roll it down, and then the market reverses really hard. And that's some of the biggest hard reversal moves you get. And in that case, they take a much bigger than expected loss on the upside, and that creates problems in that way. So that's another issue. Another place I see people having trouble with iron condors is just trading them in the wrong environment. When the volatility is extremely high, or when price cycle movements are excessively large, in other words, you look at the range of the stock or the index is trading in, and you look at the price moves back and forth, and you take a look at your condor and what kind of range you have in the condor before you have to start making all these adjustments. And if you were to look at those things and match them up, you'd see that the condor is going to have a lot of trouble. But people often don't look at that, and they start trading these things when too large of a price cycle or too large of volatility. Now, typically, the danger in that is that you just take multiple losses month after month after month after month until the market slows down a little bit, where the environment's a little bit more friendly to a condor. So that results in multiple losses. So you have to watch that. And the absolute biggest thing I see, and this doesn't include just condors, this includes pretty much any strategy you can think of, would be remaining in a trade that has gone bad. When you remain in a trade that's gone bad and you try to fight your way out of it in a manner that takes on a lot of risk, that's when we take some of our biggest losses, and that's how we blow out accounts. So we do not want to do that. All right, so just keep that in mind when we're talking about condors. And let's talk about the design of the V Condor. The V Condor uses an adjustment strategy that reduces risk in the direction of the problem. So rather than rolling back and doubling size and taking on excessive risk and hoping the market reverses, as the market goes against the Condor, we are reducing risk. Now, if you roll back and double and you happen to be right, you're going to make more money than you will doing what we're doing here. However, this is long-term a much safer way to trade, and it makes it very unlikely that you're going to take larger than expected losses. Another thing about the V Condor is we never roll down the call spread. The call spreads are put on. If they go completely worthless, we can close them if you'd like. Usually I just leave them open. Usually there's not much of a chance of it reversing and hitting the initial call spreads, although I've actually seen that happen. But if you roll them down, you have a very, very good chance of having a problem to the upside. So we just don't roll them down in this, and it actually reduces our frequency and the size of our losses by doing that. Another thing we do with the V Condor is we utilize a straddle. Now the reason the straddle's in there is essentially to help us with a little bit with the range of the condor. If you're doing a regular condor, they don't have a whole lot of range. Yes, you're selling 10 delta options, but the reality is if you're keeping a responsible loss number, which is about the amount of credit that you get, if you're doing that, or actually a better way to do it would be to max yourself off at around your average win. If you're doing that, you actually don't have a whole lot of room if the market's really moving before you have to make substantial adjustments. And the V Condor is, with a straddle in there, it actually widens that range out quite a bit, which is fairly helpful in the context of making the trade a little bit easier to manage. Also, having that straddle in there when you start making the adjustments the way we make them, a lot of times with a regular condor, when you make your adjustments, you're creating extra gamma. This here, as we adjust it, the gamma typically gets less and less, and that way, if the market takes this huge gap as the position goes against us, usually it's not too bad. Another thing we're going to put in the guidelines is a no trade filter, or a time when you do not trade this. As we were talking about earlier in the mistakes traders make with condors, one of those was that they trade it in high volatility. Condors in general are not very good with really wide price movements. The V Condor is no exception. It can take wider price movements than most condor strategies. However, if we get into this situation where there's an awful lot of, or much more than normal price movement for the volatility level, or if you're in a very high volatility environment, such as the 2008 crash and afterwards till mid 2009, or the crash after the flash crash, or after the 2011 crash, those were all periods of time where condors did very, very poorly, and the V Condor did pretty poorly as well. And that's just a reality of trading condors. You don't want to be in those environments. So what we're going to do is we're going to put a filter in there to keep you out of that. Unfortunately, I cannot close the position for you, nor can I make a rule set to get you out of a trade if the trade goes bad. Or put it this way, I can make a rule set, but I can't make you follow that rule set. So I can't close the position for you if the trade goes bad. That's your responsibility. If you choose to be a poorly disciplined, irresponsible trader, it least the adjustment strategy in the V Condor, assuming you follow it, is designed to minimize the damage to your account. Because as the trade goes against us, we're flattening. All right, so let's go and talk about the risk parameters of the V Condor. There's two ways to trade this. You can trade it all in the Russell, or you can trade it in the Russell and partially in the IWM. If we're trading it just in the Russell, we have a very big planned capital number. It's $50,000. And if that is too much for you, what we can do is go to the Russell in the IWM. And I'm going to kind of go over both of those strategies. But assuming we're doing it just in the Russell, we're going to have a planned capital of $50,000. We're going to have an average winning trade in general if you're trading this strategy properly. A $3,000 gain for this strategy is an average good month. Occasionally, things go just right and you get up in the $7,500 range for a $50,000 trade, which is a very good return. Those are seldom. I don't have an actual profit target for this trade. If I were to call a profit target, I would say $3,000. However, I would call that a soft profit target because I'd want to stay in case I hit the $7,500 range. Typically, if this is up $3,000, you're in a pretty safe position. And depending on how you're positioned, if it looks like we have actually the possibility still available to us, depending on how the trade went, to get it up into that $7,500 range, I'd probably push it as far as I can. Our maximum acceptable loss on this strategy is going to be $5,000. So we're winning. If we're on a winning month, we should be winning somewhere between 3 and 7. On a losing month, we're probably going to lose 5 because that's our maximum loss number. Although, like I said, they don't always get that bad. As far as entry criteria, we want to enter the V Condor 56 or 63 days to expiration. And that's going to be essentially when the trading cycle 2 months forward expires. So if we're entering a March V Condor, we're going to do that when the January trade cycle expires. Sometimes that's 56 days, sometimes it's 63. When we enter the V Condor, we want to make sure that our VIX is less than 35. This is the filter that we're going to use to keep us out of excessively volatile markets. I would suggest not trading any Condor strategy in a VIX over 35. Most Condor strategies are going to fail long before VIX 35. The V Condor typically, or I should say historically, has done okay in general if we are under the 35 level. So what we're going to do to enter this is we're going to sell 15 iron condors with the short strikes closest to 10 delta. If we end up with a choice between 8 and 12, we're usually going to go with a 12. So I would rather go a little bit higher delta than lower delta. And then, of course, if I have to go at 12 on the call side, for example, I'd want to do a 12 on the put side. If I end up doing an 8 on the call side, I'll do an 8 on the put side. But in general, you want to be around that 10 level. Then, after we do that sell those 15 iron condors, we're going to buy one rut straddle, and it's going to be 10 to 20 points under the current rut price. So here is an example. The Russell price is 774. We come to 63 days to expiration. You can see the November has expired, so we're going to go into January. This might be 56 or 63 depending on which expiration cycle we're in. We're going to take our closest to 10 deltas. In this case, we have 907 and 956. That's very close to 10. We sell those. We buy our 30-point wings. We come in about 10 to 20 points under the money. So here we're 774. So we come in 16 points under it. 14 points under at 760 with our straddle. And that's our entry position. In the event we want to do a smaller position, we can mix with IWM. We can do a Russell IWM hybrid of the V Condor. If we were going to do this, really the minimum size we can do this is a $10,000 planned capital number. I would expect an average winning trade when the trade wins of around $600, a high profit target of about $1,500, and a maximum acceptable loss of $1,000 this size. As far as entry criteria, it's the same thing. We're going to enter 56 days or 63 days to expiration. We want to make sure our VIX is less than 35. Instead of selling 15 iron condors, we're going to sell 3 with the same criteria as the other position. When we buy straddles, we're going to buy 2 IWM straddles, $1 to $2 under the current price. And we're essentially going to monitor it the exact same way. This is the $50,000 position divided by 10, and then multiplied by 2, right? So 50,000 divided by 10 is $5,000, multiplied by 2 is $10,000, so that's why this is a $10,000 position. The reason it has to be a $10,000 position is because I can't sell 1.5 iron condors. I have to sell 1, 2, or 3. And realistically, about the right number would be 1.5 iron condors. So I have to go to 3 iron condors and do 2 IWM straddles. Now, one note here is OptionView software is not capable of analyzing both Russell and IWM at the same time. However, there's a workaround. And we do this by entering the position in OptionView as 30 iron condors instead of 3. And then I enter the 2 IWM straddles as Russell straddles. And then I divide all our numbers by 10 to get our true position. So I'm going to show you some samples of that. As for strike levels, for your IWM strikes, what you do is you multiply your IWM strike times 10 and use that number in Russell for option view. So if you buy a 112 IWM strike, you would use an 1120 Russell strike in option view. So here's an example that would represent our RUT IWM position if we were using option view. You can see this position here would represent 3 650, 680, 850, 880 Russell condors with 2 77 IWM straddles. You see I have here, this position are all at the same strikes, except I have 10 times the amount. The 77 straddles are going to be 77 RUT calls. I'm going to put 2 of them in there. This would be the same as the position you actually have divided by 10. So to get the real numbers, we would divide everything by 10. So if we have our gain loss of $372, our real gain loss is $37.20. If our delta is minus 28, we would have minus 2.8 delta. If our gamma was 5.43, we end up with 0.45 delta. Theta is, you just divide that by 10, you divide your vega by 10, you get all your actual numbers in your thing. And this tracks pretty closely with the actual profit and loss. But the more important thing is the Greeks are going to be pretty much correct. So speaking of tracking profit for IWM, when we do this and we sell our iron condors, we're going to be selling 3 of them, but we can put 30 into option view, and we can just match our pricing. We can just say, yeah, I sold this option for $1.95, I sold this for 58 cents, or whatever, and you put the actual prices in for the Russell. When it comes to the IWM, you cannot put the actual prices of IWM times 10. If you do that, your profit and loss is going to be way off. It just doesn't work. But what you will do is you check on your broker. Check with your broker and you see what your profit and loss actually is on the broker, and you adjust your straddle price to match your profit and loss. From there, the software should track your profit and loss fairly accurately, although you should check it side by side with your broker. Occasionally you might have to adjust your IWM position to match your broker, but in general it's going to track it reasonably close. So that's how you would track that. Exit criteria for this trade under normal conditions is when the trade expires, and this is whether it's IWM or it's Russell. If I get to expiration day and my short strikes are too close to the market, within 20, 25 points, I will probably just close the position. Otherwise, I'll probably just let it expire. I won't bother trading out of it. So that's exit criteria number 1. Obviously, if it expires, you're out of the trade. Exit criteria number 2 is if the market trades under the short puts. So in this position here, we never roll back the lower put spread. If the market comes down to the lower put spread and it closes underneath the short puts, the position is closed. We're going to exit the trade if it exceeds our maximum loss of $5,000. That's in the Russell position. Or if we're in the IWM position, if it exceeds our maximum loss of $1,000. We're going to exit the trade if we're less than 10 days to expiration and the market's within 20 points of the short puts. I don't want to get near expiration and be next to my short puts. And I'm going to exit if my short strikes are within 30 points of the current price at the end of expiration day. So I come to the end of expiration day, if I'm within 30 points of my short strikes on either side, I'm just going to exit it. I'm not going to expire it. If I'm more than 30 points, that's pretty safe. The market or the Russell's only gapped more than 40 points for an expiration settlement value one time in history. So very, very unlikely there. As far as trade adjustments, I know this presentation is called Super Simple Spread Trades. The V Condor is not really super simple. It's somewhat easy to manage. It's more of a somewhat simple strategy. So we do have some things going on. It's easy unless you have to roll the position up, because we do roll the position up sometimes on a V Condor when the market's goes up excessively. Now, this doesn't actually happen very often. The time period that we're going to be testing this, it does happen a lot because I want to show you how to do it. So I'm going to show you multiple times how to roll this thing forward, because that's the most complex adjustment that you'll do. There's many, many months that go by that you don't have to do this. If you get a year like 2013, where we're getting these really wide market cycles, which generally isn't that good for a Condor strategy in general, you will end up doing multiple rolls sometimes. But here's the adjustments for the V Condor. First, we're going to talk about upside adjustments. Again, the upside is the most complicated. We're going for the $50,000 position. We're going to allow minus 100 delta for the trade. If we hit that number, our adjustment is to buy back short calls to bring delta down to minus 80. Then, when we do that, we want to check our delta theta ratio. Our actual theta number, we want to be over 80. And we want a delta theta ratio of less than 1 to 1. In other words, our delta should be less than our theta, and our theta should be over 80. And also, when I'm buying back these calls, I can only buy back a maximum of 5 calls. If I hit a 1 to 1 delta theta ratio, or if I can't hold after the adjustment 80 delta, then I have to do a roll of the position. In other words, I have to roll back the short spreads and move the whole condor higher. So the process for doing that looks like this. If I have a delta theta ratio greater than 1 to 1, or more than 5 calls needed to be purchased in order to correct the delta number to the upside, again, this is just an upside. What I'm going to do is I'm going to take the call spread off. I'm going to roll it back 20 points. And that's assuming I can get $1 credit for the short strike, and then I'm going to proceed to number 2. I'll roll up the put spread 40 points, or as high as it takes to get at least $1 credit for the short strikes, and the new short put strike must not be greater than 10 delta. Then I'm going to, so I roll essentially a normal rollback would be rolling the calls back 20, rolling the puts up 40, and then taking the center straddle and just centering it between the strikes. The new delta, once I enter the trade, should be less than negative 80. If it's not, then when I roll back my spread, I have to have less than 15 calls or short calls in the spread. And there's going to be multiple examples here, so this will make sense when we go through that and you come back here and look at this. Now, if I roll back my call spreads and $1 can't be obtained from my short strikes, right? This is not $1 for the spread. It's $1 for the short strikes. If I can't get $1 for my short strikes at 20 points higher, I'm only going to roll back 10 points. If I can't get $1 10 points, which happens sometimes near expiration, I'm going to skip the rollback and I'm just going to go and roll up the puts, and that's it. If you remember, I said in the rules that we don't roll down calls. Usually it's okay to roll up puts. The thing is, when you roll down calls, you get an expansion in volatility, and probably 75% of the time you get blown out to the upside. When you roll up puts, you usually get a contraction in volatility, and probably 75% of the time you're okay. There is still that 25% of the time, and like I said, these are numbers I kind of pulled out of my head from just past experience. There's nothing scientific about it, but what I'm saying is most of the time When the market's going up, the volatility tends to get less. Usually you're better off rolling up the put strikes than, as long as you're doing it to a responsible level, than you are rolling down the call strikes. Now there are those cases where you kind of get caught at the top of a trend and you get pushed out to the downside, but if you're rolling up responsibly, you should be okay there. So let's move on. Our downside adjustments are different on a V Condor. They're just very, very simple. The only Greek consideration is the trade delta. I don't care if my delta theta ratio is off. I don't care if my theta is negative, and I don't care if my volatility is positive. All I care about is a trade delta. This trade has a maximum positive delta of plus 50. And if the trade hits plus 50, I'm just simply buying back short puts until my delta is plus 25. I'm going to ignore my delta theta ratios, until an upside adjustment is required. So what might happen in this trade is the market might come down. I might buy back short puts. When I start buying back short puts, my theta goes negative very quickly. That's okay. We're going to allow the theta to go negative. We're not going to worry about it. We're waiting for the market to have its bounce. All we're trying to do is we're trying to hold the trade off of our maximum loss numbers until it bounces. And then once it bounces and it gets back towards the upside, if we have to make an upside adjustment, then we have to worry about maximum theta. We more worry about our delta theta ratios. But until that adjustment's required, I'm not even going to be concerned about it. And of course, if the market comes down so much that we hit the short puts near the end of the day, then we're just going to close the position out anyway. The other thing that we might run into here with a V Condor is we have that straddle. And this trade kind of goes under the premise is I enter the trade, I'm not going to be here near the end of the trade. In the event you are there near the end of the trade, then the straddle can cause some problems. Obviously, it's cost you a lot of money. You would have been better off being in a regular Condor if you get into one of these and the market doesn't move, because you pay to have that V in there. You pay for the volatility protection. So that being the case, there are some times where you need to do adjustments or completely remove the straddle altogether. So this is probably the only really subjective adjustment in the V Condor. In general, what I want to do is I want to leave the straddle alone, unless the following occurs. If the price of the Russell is 20 points over the long call of the straddle, or a strangle, right? Because if I might be in a straddle, or later on I may adjust this out to a strangle. If it's 20 points over that and the trade delta, remember we had a maximum trade delta of plus 50. So if it's 20 points over that and the trade delta is plus 50, then I'm going to either roll the long call of the straddle up and the long put down until the delta is about 25, or I may have to remove it. Or when I look at it, it might be better off to remove it, because I might be in a situation where if I roll it up, I'm not going to make any money, right? So I might just remove it completely. So we're going to go over a couple of situations here, and we'll show you how we make judgments on that. I have a note here that there may be unusual cases where the trade delta is abnormally positive. So, for example, if we're far from expiration, we're near the center of the position, yet the delta is crazy positive. In this case, we're just going to ignore the positive 50 delta guideline until we get back closer to the actual puts. This sometimes happens depending on how the options pricing skew is. In other words, we're sitting right dead center in the position. There's really no problem, but the delta is just crazy positive because of the way they happen to be pricing options. That's kind of rare, but you'll kind of notice it when it is, because you'll be looking at it going, hey, you know, I've been in this position an awful lot in this trade, and usually I'm around zero delta. Now I'm plus 75, and that doesn't work. So in that case, we would be ignoring that. Obviously, if you're happy with your profit and loss, and for me, that's usually generally if I'm around $3,000 profit and loss, and I'm less than 30 days to expiration, and I'm very low or negative theta, then the trade's gone generally well, and it's kind of a condition where the market really hasn't done a whole lot. In that case, I'd probably just remove the strangle or the straddle to bring the expiration line up as high as I can. So I'd either widen or remove it and just kind of let the trade expire. The only exception to that is generally if the price is actually lower than the long put in the straddle or the strangle, whatever it happens to be. I usually don't want to remove it unless I'm more negative than 25 delta. So again, we'll take a look at that going forward. Trade adjustments for the IWM, they're exactly the same thing, except we're just cutting the delta numbers to represent our trade size. So if you just do the math and say I had a $50,000 trade size, now I have a $10,000 trade size, our maximum negative delta would go to 20. Our theta must be over 16. 1-to-1 delta theta ratio is 1-to-1, so that doesn't change. All this here is going to be the same, rolling the call straight back 20 points, right? Getting $1 credit for the short strikes. Rolling the put spreads up 40, getting $1 for the short strikes. Those are all the same. And the new short strikes can't be greater than 10 delta when you roll them up. That's the same as the other one. And here's the new trade delta should be less than negative 16. That's a new number because, again, we had to do the math because of the smaller position size. And that's about it. So like I said, this is just essentially the same. We just have different maximum delta numbers. If we go to trade adjustments for the IWM Russell position to the downside, again, everything's the same here, except we're doing the math to get our maximum positive delta to plus 10 instead of 50. And when we come back, we buy back the short puts until our delta is plus 5. And again, this trade is still designed to be exited if the price exceeds the short put. So like I said, this is the same as the other position with just different delta numbers. Same goes for the straddle. We're just using the delta numbers. You can read through this and work with those numbers. So here is our first example. November 16th, 2012, Russell price at $774.80. We find our 10 delta shorts, find they're at 680 and 850. We buy our 30-point wings. We buy a straddle below the market. In this case, 14 points. It's between 10 and 20. I also take a note of the VIX number, 16.41. Again, I don't want to trade this in over 35 VIX. Here's our trade entry. We ended up being 9 delta on the shorts, which is close to 10. And there's our straddle. Our entry delta is about minus 13. That's pretty much normal. If we take a look at a position, it looks like this. I'm not particularly concerned if my V is under my zero line. Depending on volatility levels and the way they're pricing things, sometimes it's significantly above the zero line, sometimes it's below the zero line. For the purposes of this course, we're going to enter whether it's above or below, and we're not going to take that into consideration. If you'd like to get this a little higher, and you have the money to do so, you can buy a few more contracts on the Condor and pop this up a little higher. If it's a little low for you, you can do a few less contracts on the Condor. You can get this a little bit lower if it's too high. So those are ways that you can do a modification to this. Generally, if I'm getting a very low V, to me, that's telling me something. It's telling me that the market makers think the market's going to move a lot. That being the case, I might want to go with it and let the V sink below the zero line and have the extra protection with the price movement rather than trying to force it over and then max lossing out faster if the market happens to move. So I usually go with the opinion of the people who have more information than I do, and they certainly do. So, but anyway, this would be a normal trade entry here. So if we move forward, right, we started here at 11/16, 2012. If we move forward in this case to 11/23, we have a delta, a negative delta here of minus 108. That's too high. I want to cut my delta down to around minus 80. So depending on my position size, I may or may not be able to do that, get that number exactly. In other words, I might have to go 85 or 75. I might have to make that choice. In this case here, if I buy this back, I have a minus 89 delta. That brings us down to that. But my theta is less than 89. It's actually 83. So I have over 80 theta, but I don't have the 1-to-1 delta theta ratio. In this case, if I bought 2 back, it brought my delta actually a little bit lower than I wanted it to, but it also brought my theta under 80. So this is kind of rare. As a matter of fact, this is very rare to happen this early in the trade. Usually it happens a little bit later. But I'm actually having a delta theta ratio problem very, very quickly. That's kind of telling me something in itself, right? And this is one of the things I want you to notice when you're trading these. If you're trading the same thing month after month, you should be noticing differences like that. You know, month after month, if I have to make this first adjustment for my delta, I never have a delta theta ratio problem. Now all of a sudden I do, right? That's very unusual. Well, that's kind of odd. If you say that to yourself, and then see if you can find something that happens after that, something like that happens. In the case of a V Condor, if I'm having a delta theta ratio problem this early, that means everybody thinks the market's going up, and they think it's going up a lot. So you could make modifications to deal with that, but we're just going to follow the system here. So since I can't buy this back and get the numbers that I want, I'm going to have to do the roll. This is what the existing position happens to look like. So this is what I'm going to do for an adjustment. I'm going to roll this spread right up here back 20 points. Then I'm going to take my lower spread. I'm going to roll it up 40 points. That'd be the first part. Then from there, I'm going to take my straddle and I'm going to put it in the center of the position. So I'll just go, like 870 minus 760 is 110, and you divide that by 2 and get your strike price you're going to put it at. And you're going to be between two numbers, and I'll go with the lower number. But that's generally what we're going to do. So we're just going to put it approximately in the center. In this case, halfway between 760 and 870 is about 970. This is what our new position looks like when we're done. We cut our delta down to minus 26 in this case. If we did that roll and our delta was still too negative, then we would start buying back, or we wouldn't have sold as many of these 870s. But this is the new position here, and this is fine. If we look at our new position versus our old position, we rolled the whole position up, we made it a little bit tighter. So we go forward to December 11th. Once again, we have a delta problem, and we're minus 127 delta. In this case, if I buy back 3 of these calls, it brings me down to minus 68 delta. If I bought back 2, it was well over 80 delta. So I went for the minus 68 delta, and I did that because I could hold my theta over 92. And this is actually a decent ratio. So I have a better than 1-to-1 delta theta ratio. I'm good there. I have a nice high theta number. If we go to the next slide, this is what the current position looked like. And that's the new position versus the old position. You can see we're really cutting the gamma out of the trade, and we're taking the catastrophe of a huge, huge loss out of the trade as the trade continues to go against us here. So that's December 11th. If we go up to the 18th, the market continues to rise. I attempt to buy back 2 more of these 870s, which is essentially all that I can buy back under my guidelines. If I had to buy back more than 2, I'd be left with less than 10 here, and then I would have to make the roll anyway. But I buy back these 2 to get my delta to around minus 80, and I notice my theta is down to 66. That being the case, I'm due for another roll. The amount of times that you need to roll this position twice is extremely rare. Very, very unlikely. Like I said, we just went through a period of time where that was a little bit more common. But if you go through history, it's very, very unlikely. It's very, very seldom you have to do something like this. But anyway, we're going to do it because we hit those numbers. So this is what our current position looks like here. Yes, our V is getting collapsed under here. We're going to keep it there. Essentially, if I take it out, I don't have much chance of making any money here. Plus, I start taking on a ton of risk to the upside. So I don't want to do that. I want to leave it in. So we're going to do a roll-up adjustment. we're going to roll this back 20 points. Notice we were short 3 calls here. We're going to add them back in. So we're going to roll back, add back in the calls. I'm just barely over $1 here for my short strikes. It's okay, but just barely. Actually, no, I'm sorry. I'm $2 for my short strikes, so I'm actually fine there. Then what I'm going to do is look at rolling my puts up 40 points, make sure I have $1 for that, and I do. So that's the first part of the roll. The second part of the roll is centering my straddle in between my new short strikes. And my position comes up with negative 60 delta, which is fine. And my theta is 132, which is good. If we take a look at our old position in green and our new position in pink, yes, we are taking on a bit more downside risk, upside risk now, but we're doing that with a whole lot, with a wider tent. So that's what our new position looks like. You can see we are getting progressively more narrow here to keep our expiration graph high. So if we go to December 20th, the market's still going up. We take a look at this, we're minus 121 delta. We need to buy back 3 of these calls. Gets us down to 72. We still have 110 theta, so that's still good. We take our old position is in blue, our new position is in red. We're starting to pull off our upside risk here. Getting pretty sad from a potential profit standpoint here. This is where a lot of Condor traders get in. They try to make things super tight, and when they lose a ton of money. Rather to take a regular loss or a regular max loss than to take that kind of a loss. So it's good to be responsible. And like I said, the adjustments in this trade try to keep you as responsible as possible with your loss numbers. If we go forward again to January 2nd, our delta is too high once again. I try to buy back these short calls. I find that I can't buy them back. If I buy 2 back, it doesn't correct my delta enough. So my rules basically tell me to roll back 20 points. If I roll back 20 points, I only have 75 cents time premium on my short option. I can't do that either. So can I roll 10 points? In this case, yes. I still have $1.62, 10 points higher. I can roll back 10 points. That's the best I can do. So I'll roll back 10 points. If I roll these bottom ones up 40 points, I only have 92 cents of credit. That's not enough. So I take them and I roll them up 50 points, where I have $1.18 credit. So we're going to make those rolls. We roll this one 50, we roll this one 10, we add in our 15 short strikes. So we go from minus 12 to minus 15. We come in here, we do our second part of our adjustment, and we do both. We notice we have minus 87 delta. That's a little bit higher than we want, but it is reasonable. So I can live with that. Had it been 90, 95, near 100 delta, no, I probably would have had to buy some of these back. But 87 is okay. So here is our old position back here. Here's our new position here. Still have a reasonably wide range that we can deal with here. So we move to January 4th. The market's still going up. We come here. We go to buy back our short strikes, and we buy our maximum amount back of 5, and it brings us down under minus 80. And we keep our delta theta ratio, so that's actually okay. I don't have to roll them back again. Not that I could, because I only have 80 cents here, but one of the things I could do is I could roll up my short puts a little bit all the way up into this range here, and then recenter my straddle. I could have done that if this didn't bring it back, but this was just borderline enough to bring it back. So we buy back those 5 calls. There's our new graph versus our old graph. Again, you can see we're taking off our devastating risk to the upside here. We go to January 14th. We've exceeded positive delta. But this time, wait a minute, we're not that close to the short strike. What happened? Oh, we exceeded positive delta. We didn't exceed negative delta. We exceeded positive delta. And we're 20 points over our straddle. Ah, it's time to do something with this straddle. So let's take a look at what we do. In this case, because we're so close to expiration, if I had sold this call and bought something higher, I would have killed the trade because that's the only place we have time value, right? So really the only choice I have here is to completely remove the straddle. Realistically, I could close the trade at this point. I'd have a small $1,500 profit, but like I said, this was a trade that did not do well because we had a double, almost a triple roll up. So anyway, to correct our positive delta problem, we get rid of the straddle. Our new trade looks like what we have in red here. And from there, normally I would let it just expire. But in this case, we're very, very close to our short strikes. If we take a look here, we're within 30 points of our short strike. We're within 20 points of our short strikes. Almost 10 cents, 10 points within. This is kind of risky to expire. Had we been back here at the 870 level, 872 level, I'd just leave it alone, let it expire. But because we're so close to our short strikes, I actually have to close out of this position. Here's why we had so much trouble. Like I said, it's very rare to have to move the V Condor once, never mind multiple times. We ended up entering right at the bottom of a capitulation here, and the market just went up and up and up and up and up. And then when we thought we were topped out, it went up a lot, and then it continued to go up. It never slowed down. So this caused us a little bit of heartburn this cycle. But as you can see, we still turned out okay. So here's a T-log for this particular trade, in case you'd like to see it. Part 1 and the end of the trade right there, so that you can follow along. And that in a nutshell is the V Condor. The best way to get you to completely understand the rules though is to show you several examples. So what I did here is I'm going to cut this presentation off right here on part 4, and I'm going to add a whole part in part 5 where we just do V Condor examples, and they're going to be essentially live with option view. And you can kind of follow along. I'll go through my decision process, what I'm going to do here. I'll show you a couple of winning trades. I'll show you a couple of losing trades. And it should be very educational and really cement in what's going on. So we'll see you in part 5.